Good afternoon. Kindly confirm, can you hear me and can you see my screen?
Yes, we can see your screen.
Oh, good, sir.
That's good. So welcome to our third revision session for financial accounting. So we were looking at this same mock exam yesterday. So I want us to proceed and look at the other things we did not manage to cover in our previous session. So let's quickly navigate to where we were in the last session. I think we had covered all this. Anyone who can still recall, or we were on number what? Had we covered this? Coletta, you're saying what? I can't hear you. I don't know, maybe let me adjust my volume this side. Oh, my volume is okay. Anyone who can hear what she's saying and maybe say it a bit louder? I think I covered 19. Yes, we had not covered number 19, but let me check 18. Yes, 18 is the last question we did. So now let's get started. Now we are on number 19. According to IAS2 inventories, which two of the following costs should be included in the valuing inventory of a manufacturing company? So if we are valuing inventory, which two costs qualifies to be part of the cost of inventory? In a manufacturing industry, what is it that, remember, if it's a manufacturing industry, we are producing. And the cost that we have incurred in production, it does contribute to the value of inventory. So the question is then say, identify two costs which are part of inventory according to IAS2, which we can include as part of inventory value, which we include in valuation of inventory. Anyone to try that before we move? Yes, Precious? Precious is saying A and B. Okay, so for the sake of progress, if we are valuing inventory in a manufacturing setup, we are looking at the cost of, because you're going to value inventory at total cost of production. So we are looking at costs that are associated with manufacturing, because it's either we buy inventory or we produce inventory. Inventory is valued at the lower of what? Cost. The cost can either be the purchase cost or the production cost. So if it is the production cost, we have to look at the manufacturing cost. If it is the purchase cost, we just consider what is the price in the industry. So now the question is, in other words, the question is, which costs from the ones that we are given, which costs qualify as production costs? So if we are in a manufacturing industry. If we are in a manufacturing industry, the production cost, we look at the cost of, this is the same Excel sheet we've been using, right? So in production, we look at the manufacturing cost, of which manufacturing costs are made up of what? So manufacturing costs are made up of, we have the direct costs and the indirect or factory overheads. So in manufacturing, we are going to incur the direct costs. So the direct costs, this consists of the material costs. We have the labor cost. We have the, so we have the material cost. We have the labor cost. We have other direct costs such as royalties and patents. So these are the direct costs. We can have material, we can have labor, we can have royalties in production. Then besides the direct cost, we also have the factory overheads. Factory overheads are the indirect costs. So the factory overheads, this is where we have the factory rent, the factory rates. We have, so for the factory overheads, we have the depreciation for plant, the repairs for plant, or we can say costs associated with the plant, because the assumption is that you can say operating costs for the plant. The assumption is that if we are operating a manufacturing and a trading department, the machinery, the plant and machinery is used in the manufacturing department. Unless they've mentioned otherwise, we assume that the plant and machinery is used in the manufacturing department. So the factory overheads, for the factory overheads, we are going to be including the depreciation for plant. We also include the repairs for plant because we assume it's a factory overhead. Then, looking at the question that we have at hand, we are given carriage inward. Carriage inwards is part of material cost. It's actually included in calculating the materials used in the cost of raw materials consumed. So the carriage inwards is part of material cost. It's included when you're valuing inventory. Then the carriage outwards. Carriage outwards is not part of the cost of the material because carriage outwards is the cost we pay to transport finished products. It's not a cost of producing the product, but it's a cost that we incur after the production. We are now carrying the goods out of the warehouse after the goods have been produced. So the carriage outwards, we incur that cost after the goods have been produced. So we leave that one. Then there was depreciation of factory machinery. Like I did mention, factory overheads include the depreciation for plant and machinery. So we add the direct and the factory overheads to get the cost of the inventory. Provided we have produced on our own, the cost of the inventory is the direct cost plus the factory overhead cost. So now with that in mind, I think you can now be able to tell the answer there. So the correct answer, it should be the carriage inwards and the depreciation of factory plant. The carriage outwards and admin overheads, these ones are incurred after we've already produced. They are not production cost. So we want the cost of producing the inventory. Prisha, a sole trader, has not kept accurate accounting records during the Sorry, let me just record for. Let's proceed. Prisha, a sole trader, has not kept accurate accounting records during the financial year. She had opening inventory of 6.7 and purchased goods costing 84,000 during the year. At the end, she had 5,400 left in inventory. All sales are made at a markup of 20%. What is Precious gross profit for the year? So what are we given? If we are dealing with incomplete records, always, if you are dealing with incomplete records, first of all, determine what is it that you are given. So in the question, they have given us, or let's actually go to our Excel. Please help me memorize this. We have inventory, we have purchases, we have, yes, so we have inventories and purchases. So they're asking for gross profit. So if you have inventories and purchases, having inventories and purchases, to get gross profit, you know that you have to say sales minus cost of sales, but we don't have the sales in this case. But we're given markup. If you're given markup, what is the relationship between the markup, the cost of sales, and the gross profit? If you are given the markup, if you say the markup times cost of sales, markup, if you multiply the markup with the cost of sales. So the markup times the cost of sales gives us the gross profit. So optionally, without saying sales minus cost of sales, if you are given markup and cost of sales, you can be able to work out the gross profit. So the markup is given. The markup is given as, I think it's 20%. So we are given the markup is, I think that's 20%. So we having the markup as 20%, what is the next thing that we need? We need now to work out the cost of sales. So we have the markup, what's left is determining the cost of sales. So the cost of sales is calculated using the formula. The cost of sales, we say the opening stock. Remember, we can use the income statement layout. So to work out the cost of sales, we can start with our opening stock. Since we are given the opening stock, let's actually substitute that. So we have the opening stock or opening inventory. How much is our opening inventory from the question? 6.7. Then we add the purchases. How much are the purchases? 84,000. So opening stock, we add up the purchases. Then we less the closing stock, closing inventory. How much is the closing inventory? 5.4. So this will give us our cost of sales figure. There wasn't any adjustment for carriage inwards, purchases, returns. So we just use what we have. So the figure we have here is the cost of sales figure. Having this one as our cost of sales figure, we then go to our formula, markup times the cost of sales is equals to gross profit. So we're saying 20%, that's our markup, times the cost of sales figure, which is 85,300, should give us our gross profit. So quickly, can you help me with that? What's 20% of 85,300? Work with me. What's 20% of 85,300? Let's be fast. So that's about 17,060. So that's the value for our gross profit. So that becomes the value of our gross profit. Time is not on our side. Let's move. So let's move to the next question. So let's go and verify that one. So that's 1706. 1706, 17060. Yes, that's correct. So let's move. At 31 December 20X4, a company's capital structure was as follows. Company's capital structure was as follows. The company's capital structure was as follows. We had ordinary shares of 125,000, of which we are told that each share is of 25 cents. So it actually means we had 500,000 shares of 25 cents, each giving us a value of 125,000. Remember, in shares, we have the number of shares and the value of shares. The 125,000 is not the number of shares, it's the value of the shares. So each share is of 25 cents. Each share is of 25 cents. And we are told we have 500,000. So if each share is of 25 cents and we have 500,000, 500,000 times 25 cents is what gives us 125. Indeed. So the 125 is derived from multiplying the 500,000 times the 25 cents. Then let's move on. We have the share premium being of 100,000. In the year ended 31 December 20X5, the company made 1-for-2 rights issue at $1 per share, and this was fully subscribed. Later in the year, the company made 1-for-5 issue of bonus shares using the share premium for that purpose. So remember, let's go to our Excel and have a quick recap of that. So when the shares are issued, we can have issue of shares. Just a quick recap. So for the issue of shares, remember we can make an issue at full market price. So we can make an issue at full market price. We can make an issue at full market price. We can also make a bonus issue. So a bonus issue, we did mention, this is when shares are issued to existing shareholders at no consideration. They don't pay for these shares. They are issued for free to existing shareholders. That's a bonus issue. Then on the other hand, we have the rights issue. Again, this one is given to existing shareholders, but a rights issue, they pay a price which is less than the market price. So if it's a rights issue, they pay, but what they pay is less than the market price. They pay a price which is less than the market price. Okay, let's proceed. Okay, so issue at full market price. So the issue at full market price, This is where we are issuing at the normal price that we're selling, that the company uses. Then a bonus issue, this is when the shares are given for free to existing shareholders. Then a rights issue. If it's a rights issue, the rights issue, these arise when shares are issued to existing shareholders at a price below the market price. At a price below the market price. Okay, so let's move on. For a bonus issue, it doesn't affect the bank, but issue at full market price, we debit the bank. If it's the issue at full market price, you debit the bank. If it's an issue at full market price, you debit the bank and you credit. So for an issue at full market price, you debit the bank and you credit the shares. Because when we issue the shares are going to, the number of shares that we have are going to increase. So the share capital is going to be credited. Remember when we did our double entry, shares have a credit balance. So if you make an issue at full market price, it increases the amount of money in the bank. It also increases our shares. In some instances, the shares can be made at a premium. It also increases share premium. Share premium, we did mention this is the price we have charged above the par value. So for a share premium account, it also has a credit balance. So the share premium also is credited when we issue the shares. So this is how the entries that we are going to have. These are the entries that we are going to have. If it's an issue at full market price. Then if it is a rights issue, full market price and rights issue is the same. So this one we can say issue at full market price and rights issue. And rights issue. So the treatment is the same. The only difference is that the full market price gives us a higher amount than the rights issue. The rights issue is going to be discounted. Then a bonus issue. If now it's a bonus issue doesn't bring money in the business. So if it is a bonus issue, what we are going to debit, if it's a bonus issue, you don't debit the bank, but you debit a reserve. So a bonus issue, what we debit is a reserve. In most cases, in fact, we are supposed to leave the reserves in their most flexible form. So leaving the reserves in their most flexible form, we normally start with the share premium. We start with the share premium. That's what we debit. Debiting the share premium is removing money from the share premium. So if you make a bonus issue, it reduces the share premium. How does it work? The debiting the reserves system, how does it work? So let's assume we had the following before the issue. The share premium, you can say the equity and liabilities section of the balance. So the equity and liabilities, we have our ordinary shares. So assume we have our ordinary shares, the ordinary shares 100,000. Then besides the ordinary shares, we can be told we have share premium. So we have share premium of, let's say we have share premium of 10,000. Then we have general reserve. General reserve, 2,000. Then retained earnings. Retained earnings, 30,000. Then we are told that these shares, let's give them the par value of $. Then we are told that a bonus issue of let's say 2 for every 5 shares. Held was met, leaving the reserves in their most flexible form. Leaving the reserves in their most flexible form. So leaving the reserves in their most flexible form. My reserves, share premium is a reserve, general reserve, retained earnings. So these 3 that I'm going to mark are reserves. These 3 are actually reserves. So leaving the reserves in their most flexible form, it means you start with the first reserve, then you move to the next, then you move to the next. So starting with the first reserve to do what? Let's do this one. So we made a bonus issue of 2 for every 5. So we need the number of shares. So the number of shares we issued as bonus issue is 2 for every 5. That's 2 over 5 of the shares that are there. 2 over 5 of 100,000. So 2 over 5 of 100,000. Two over 5 of 100,000 is giving us 40,000. May I adjust on the question? Let's check. Let's change this one. Let's add a 0 to general reserve there. From 20, let's just add one more 0 from 2,000 to 20,000. So it means that we are supposed to debit a reserve. We credit the number of shares they've increased, but we debit a reserve. But the problem is we are supposed to debit the reserves starting with the share premium. We are supposed to debit a reserve starting with the share premium. But how much do we have in our share premium account? We have 10,000, but we need to debit how much? 40,000. So we can't debit more than what is in the share premium. Debiting, it means you're removing from the share premium. You can't remove more than what is in the account. You can't take away $40 from a pocket that is $10. So what do? It means now, if the amount of shares you are issuing as bonus issue are exceeding the balance which is in your share premium account, you first of all clear the balance in the share premium account, the 10,000. Then you move to the next reserve. Which reserve now? That's when you use the rule to say in their most flexible form, you start from the reserve here going down. So after share premium, you move to the general reserve. General reserve. If the money was enough from the share premium, we didn't have to move to the next reserve. General reserve is 20,000. Again, still, it's not enough because we want what? 40,000. So we move to the next reserve, which is retained profit. But in retained profit, we are not going to take the whole of 30,000. How much are we left with now? 10,000. So in retained profit, you're just going to take the remaining 10,000 to make it 40. So in this case, we have left the reserves in their most flexible form. Then you credit your share capital. You credit your share capital. So if you're crediting the share capital, you credit it with the amount of shares you have met for bonus issue. What if the shares were not of dollar? What if the shares were not of dollar? If the shares were not of dollar, it means you are going to multiply this 40,000 by the par value. So you multiply the number of shares 2/5 times 100,000 times the par value. If they were not of dollar, you multiply with the par value. That will help you know how much you're going to take from the share premium and general reserve and retained profit. Okay, so with that in mind, I want you to try the question, then we do it together. Quickly try that question. Quickly, please attempt that. Okay, I'm sure now you can start giving me your answers. We have a lot to cover. I'm giving you 1 more minute. Try to work on your time management skills. Okay, so I think now we can do it together, but at least I would be happy if I can get to hear your answers. First, anyone who is done. So in the year ended 31 December 20X5, the company made 142 rights issue. The question was, what was the company's capital structure? What was the company's structure at 31 December 20X5? Okay, so in this case, we need to make the relevant adjustments here. So what was the company's capital structure at 31 December 20X5? So the first thing is, here, we have to, let's have the journal entries for each transaction. That can help us get, that can simplify things for us. So let me memorize the amount. So the ordinary shares were 500,000, 25 cents each, 125. Share premium at 100,000. Then the rights issue. So we first of all have to record the rights issue. We first of all have to record the rights issue. So Terence is saying a wild guess is getting C. We don't want guesses. It's not allowed. Yes, Libert is saying A. I hope Libert is not also trying his chances. So now we have an A and a C. A and C. So let's try together. So please, since you have worked it out, now you know the information, or if you have a phone, you can take a pic so that I won't have to be coming back to this screen. You can help me out with the amounts. So the company made 142 rights issue, that's 1/2. This was fully subscribed. The rights issue was made at $1. Okay. Let's go and record the rights issue first. Let's record the rights issue. So we're going to start with the rights issue. So the rights issue, like I said, it affects the bank. So if it is the rights issue, it affects the bank. So we are going to debit the bank to show that money has been received in our bank account. Debit the bank to show that money has been received. Then, so we debit the bank and we credit. So we debit the bank and we credit the share capital. It's not just the share capital, there was an element of premium. So we credit the share capital and the share premium. So let's go and fill in the amount. So Firstly, let's know how many shares, because we're not told how many shares. We were told that there was a rights issue of 1 for every what? Is it 1 for every 2? So we're saying 1 for every 2, that's 1/2 times the shares. We had 500,000 shares, not 125,000. 125,000 is the value of the shares. So we had 500,000 shares. So we made 1 for every 2. That's 1/2 times 500,000 shares. So it means the bonus issue was for 250,000 shares, right? So we are told we made a bonus issue of a rights issue of 250,000 shares at a price of $1. So we sold these shares at a price of $1. So in the bank, we're going to have 250,000. But the share capital, the amount that we record in the share capital, you take the 250,000 shares, you multiply by the par value. What was the par value of each share? 25 cents, yes. So we multiply by the par value. So this becomes 250,000 times 25 cents. So multiply with the par value. Then after that, the share premium, now we're going to say for the share premium, you take again 250,000 times. If we sold at $1 and 25 cents was the par value, how much was the premium? Remember, the premium is the difference between the par value and the price which we, the issue price. So if we are selling at $1, shares that have a par value of 25 cents, then the 75 cents is the share premium. So it means here that's 250,000 times 0.75. So that's how we record the rights issue. Now, after the rights issue, I think there was there a bonus issue? So for the bonus issue, if it's being made after the rights issue, if the bonus issue is being made after the rights issue, firstly, let's know the total shares available. Before the bonus issue, because the rights issue had already been made. So before we started with 500,000 and we added 250,000 shares. So it means now we have a total of how many shares? 7, is it 500 plus, that's 750,000. So we started with 250,000 and we made a bonus issue of, we started with 500,000 and we made a bonus issue of 250. Bonus issue increases the shares. So, the rights issue increases the shares and the bonus issue as well. So it means when we are going to make the bonus issue, our shares won't be 500,000, but it's 750 because more shares were added that they added the rights issue. So now let's go and check. And the rights issue, the bonus issue, it was how many for how many shares? What was the ratio for the bonus issue? 1 for every 5. So bonus shares. So for the bonus shares, 1 for every 5. That's 1/5. Of how many shares? 1/5 of the shares which we now have. 1/5 of the shares which we now have. Then I said that if the shares are not of dollar, you can multiply with the par value of each share. So if you are recording the bonus issue, you multiply the ratio times the number of shares that we have, then you multiply with the par value of each share. So this gives us what? Multiplying that gives us what, please?
37.5.
37.5. Thank you. So 37.5. So 37.5 is the value for the bonus issue. Of course, the bonus issue, in terms of, maybe before we get to 37.5, the bonus issue, if you want to know how many shares did we receive from the bonus issue, maybe let's reverse, let's go back a bit. Before we multiply by 0.25. So we are saying for the bonus issue, we gave 1 for every 5. We had 750,000 shares. So 1 for every 5 is what? What's 1 over 5 times 750,000? $150,000. These are shares. It's not the value of these shares. Then, so it means the bonus issue, we got 150,000 shares. What about the value of these shares? So the value of the shares, it's 150,000 times the bonus issue, you multiply it with the par value. That's 375. 37.5. So now let's go and summarize that. The question was saying, what is the balance in the share capital account? So share capital, we had original balance, opening balance. The share capital, we had our opening balance, which was how much? The opening balance for the share capital, it was 100,000, was 125,000. Or maybe dealing with the shares, we started with 500,000. Then we increased our shares through a rights issue. Rights issue, we increased our shares by 250,000. Then we made a bonus issue. So bonus issue. Through a bonus issue, we increased our shares by 150,000. So overall, how many shares do we now have? So overall, now we have, can sum that up. So we have 900,000 shares. So share capital, we have 900,000 shares, but each share is of 25 cents. 900,000 shares at 25 cents each. So the value of our share capital becomes, because having 900,000 shares at 25 cents each gives us what? What's 900,000 times 25 cents each? So the value of our, it means at the end of the period, we now have 900,000 shares and they have a value of 225. But in the books, we are going to record a value of 225,000 shares. What about the share premium? So for the share premium, the share premium we started with, so the share premium we recorded at the market value. We are not using the par value. So for the share premium, we take the value of the shares, not the number of the shares. So the share premium, we started with, what was the value of the shares? At the start, it's 100,000, yes. Then As a result of the rights issue, the share premium increased by how much? 187. Then we have the bonus issue. But the bonus issue does not increase the share premium, it reduces. So bonus issue actually reduces the share premium. So how much did we take from the share premium? From bonus issue? Was it 37.5? So meaning that after all these transactions, the bonus issue, sorry, the share premium account now has $250,000. Optionally, the share capital, we could also calculate it in this way. I used the number of shares. We could calculate the value of the share premium using the value of the shares. Like we started with the shares as 125,000. This is optional calculation. Then for the rights issue, you add the value of the shares. Remember, for the rights issue, there was this 625, which is the value of the shares. Then for the bonus issue, you remove the bonus issue, which we calculated again as 375. Sorry, if it's we subtract if we are calculating the share premium, not the share capital. So that's the optional calculation. It would still give us the same answer. So this will still give us 225. Let's go to that question and see whether we have an answer like that. So do we have such kind of an answer? And Terrence's guess was right. Let's confirm if it was indeed right. Yes, the correct answer is C. But this one, the calculations were quite hectic. Let's move on. Which of the following should be presented in the company's statement of changes in equity? The statement of changes in equity. So remember, we can have the income statement. Then after the income statement, the company has a statement of changes in equity, which shows movements in what? So let me hear from you. In the statement of changes in equity, what do we put? One and three. One is saying the total comprehensive income for the year. Yes. So we put the income for the year. And this revaluation gain, yes, Coletta is also saying B. So that's correct. We don't put amortization charges, but we put the revaluation gain and the profit for the year. Those are recorded in the statement of changes in equity. Let's confirm that. So 1 and 3 is correct. Okay, the general ledger account for historical cost of plant and machinery for business for the year ended 31 December was as follows. The company's policy is to charge the depreciation at 20% per year on the straight line basis with proportionate depreciation in the year of purchase and disposal. No item of plant and machinery is fully depreciated. What should the depreciation charge for the year be? The account is at cost, and we are told that depreciation is on proportional basis. Proportional basis means if it does not spend the whole year, we depreciate based on the months the asset has stayed in the business. That's the proportionate method of accounting for the depreciation. So if it's less than a year, we apportion the depreciation. Okay, let's move on. Just a moment. So let's move on. The company's policy is to charge depreciation at 20% per year on the straight line basis. So if we are charging depreciation using the straight line, it shouldn't give us a challenge. Let me give you a hint, then I give you time to try. So in this case, take note of the dates that they have given. So we started with assets of 240. So from 1 January, or let's actually do it together so that at least it can so for these assets, we are going to group them into three. We have the assets we started with of 240,000. We started with assets of 240,000. We started with assets of 240,000. So the assets were 240,000. For how long? Is it 240 or 24,000? Let's go to 240. So the assets were 240. That is on 1 January, which is the next date. The next date is March when we disposed. So next date is March, then June, then December. So may we break the periods as follows. We have 1 January. So for January and Feb, we had 240 assets. Is it? Then from March Which is it 1st of March or end of March when we sold? Oh, it actually means from January to March, we had 240 assets. January to March, we had 240. Then from March to, when did we, June, which June was it? When we bought more assets, it was when? When we bought more assets, it was 30 June. So it means from March, let's go back to, so it means from March, in fact, let's call it April because it's the end of March. From April to end of June. Tatine assets of how much? Because Tangatine assets of 240, the Vatatenge, so it means Abba, Tangatine 240,000 minus how much? Minus 160,000. So Tangatine 80,000. Then from July to what? It's now July to December. So July to December, muna July takawedzera ma assets. Saka takawedzera emari tatine 80,000. Handeti? 80,000 ndobva tanowedzera echi. Tikatenga ma assets at which cost? Tikatenga ma assets at 160. Ndizvo? So tikatenga ma assets at 160. So tatenga ma assets at 160, it means my assets are tatana ese, it's 240,000. So those are the assets that we had at the end. So we sold 160 and bought assets for 160. Is that true? Let's check.
I think April, June, suppose.
Okay, disposal it's 60, not 160. Then additions it's sorry, can I just answer that? Hello? What's good to say? Sensor. Apa ni body lesson ka, so taura ni vana vako kana kuisa mningi because dream live lesson, so taura ni vana vako kana kuudza lesson. Hello, ndikati taura ni vana vako kana kuudza lesson dream lesson. Sorry for that. Let's proceed. So I was saying transfer 60,000. So transfer is for 60,000. So here we made a mistake there. It was supposed to be 60, not. Okay, so this is the movement that took place. So I was just breaking down the question to say, since the question is saying for every month of ownership, depreciation is charged for every month of ownership. So I wanted to check. So from 1 January to March, which assets did we have? We had assets of 240, but we sold some. It means from the period of April to June, the assets that we had, they were of 180. Then from July to December, the assets had increased. They were now of 340,000. So what do you do here? You can calculate the depreciation at 20%, but this will give you the depreciation for the whole year. So if you say 20% of 240, this will give you the depreciation for the whole year. That will give you the depreciation for the whole year. Then you say 180 times 20%. That will give you the depreciation for the whole year. Then 20% of 340. That would give you again the depreciation for the whole year. So what we have calculated is the depreciation for the whole year. But we then apportion to say the assets were 240 for January, February, and March. So they were 240 for 3 months. The 480 was 48,000 was for the whole year, but the assets were 240 for 3 months. April, May, June, the assets were also had a depreciation of 36,000 for the year, but they only had 3 months, April, May, and June. So that's 3/12. Again, this one, it was a tricky one. Then the assets were 68, the depreciation is 68,000 for the whole year, but July, August, September, October, November, December, for 6 months. So overall, what's our depreciation charge for the year? So the depreciation charge for the year we are then going to say 120 plus 90 plus 34. So that's 55. So what did I do here? I first of all calculated, so at every point in time, how much of the assets did we have? From January to March, the cost of the asset that we had was 240. But we sold some in end of March, so we were left with assets with the cost of 180. Then in December, July, we bought more assets. So the assets had now a cost of 340. So the first approach we can use is that one. However, there are different approaches to this. So I thought this one might be a bit better. The other one, maybe we can have the other approach. Maybe this one could be a challenge to you. The other approach would be to say, with assets of 240, and we sold 160. I think the other approach is to remove first the 60 that we sold from 240. Then we say, so 240 minus 60. What's 240 minus 60? 180. Then you say, so we have assets of 180,000. Then we have, so we first of all deducted those that we sold, because those that we sold were part of the assets we started with. Then those that we sold, we record them separately. That's 60,000. Then we move to those that we bought. So those we bought them for 160. So we have split the assets into 3. Those that we had at the start that we have not sold of 180,000. Those that we had and we sold them of 60. Then those that we bought. So when you're now calculating depreciation, these ones that you had at the start of the year that you did not sell, you are going to record the depreciation for the whole year, 36,000. Then the 60,000, these ones you had them only for January, February, March, for 3 months. So you are going to record depreciation for only 3 months. So for these ones, you are going to record the depreciation for 3 months. So it's first of all calculate the depreciation for the year, then times 3/12. Then for those that you bought in July, you are going to record depreciation for half of the year. So it means you are going to say 20%. Firstly, you get the depreciation for the year, 20% of the 160,000 times 6/12. Then if you sum that up, should give you the same answer. Now let's move to the next question. So the following extract are from Hassan's financial statement for the year ended 31 December. What is the return on capital employed? Those are ratios now. Return on capital employed. So the formula for return on capital employed is profit before tax and interest divided by the capital employed. Capital employed, it can be termed, you can say, for capital employed, you can say equity plus non-current liabilities. That's your capital employed. The formula is operating profit or profit before tax and interest divided by capital employed. Okay, are you done now? It shouldn't take you forever. It's just a matter of picking the amounts. It's the profit before tax and interest. So you are taking the profit before tax and interest, that's 10.2, divided by the capital employed. Capital employed, you can work it out in two ways. So capital employed, you can say, for capital employed, you can say total assets minus current liabilities. So capital employed, you can say total assets minus current liabilities. That's capital employed, total assets minus current liabilities. Then you can optionally say, for capital employed, you can optionally say, capital employed, optionally, you can say the equity plus non-current liabilities. That's how you get your capital employed. You can say the equity plus non-current liabilities. Now, with that in mind, let's go and apply it to the question. May I have the answers, please? So as for the profit before tax and interest, we are given it's 10.2. You're not calculating. Then again, the capital employed, you are given. Because the equity is 35.6 and the liabilities, non-current is 6.9. So you're simply saying 10.2 divided by 10.2 divided by 42.5 times 100. Let's move on. In each of the following statements about sales, is each of the following statements about sales tax true or false? So what can we say about sales tax? We have discussed about sales tax before. Remember sales tax, this is charged to consumers when they buy taxable supplies. So what can we say about sales tax? Is the first statement true or false? Sales tax is recorded as an income in the accounts of the entity selling the goods. Do we record sales tax as an income? Is that correct or not? That's false. Yes, you don't include sales tax in the income of the business. So Michelle is saying the first one is false and the other one is true. What is the second one saying? Sales tax is an expense to the ultimate consumer of the goods produced when that ultimate consumer is not a registered sales taxpayer. That's correct. Let's move on. Using the table below, identify whether the following general ledger accounts will appear on the debit or the credit side of the trial balance. So purchases returns, which side, debit or credit? Purchases returns, debit or credit? Online, where are you guys? Okay, Liberty is saying credit. Please, let's work as a team. I think there are quite a lot of people in class. So credit, what about sales? Which side, debit or credit? You're just using your pals here. Credit. So Liberty is saying credit, credit, then debit, debit. That's correct. Let's move. Prior to the financial year end 31 July 20X9, Canon Co. has received a claim of 100,000 from a supplier for providing poor quality goods which have damaged the supplier's plant and equipment. Canon's lawyers have stated that there is a 20% chance that Canon will successfully defend the claim. 20% chance. Remember, we did talk about this percentage. 20% shows what? Is it certain? Is it probable? Is it is it possible? Is it remote? 20%. Which category is 20%? It's possible, right? Okay, so which of the following is the correct accounting treatment of the claim? So they're claiming, who is claiming here? Prior to the financial year, Canon has received a claim from a supplier for providing poor quality goods which have damaged the suppliers, plant, and equipment. So this is a claim from the suppliers. So this is a potential liability to us. So if it's possible, how do we deal with the liability? What's the correct treatment? If it's possible, this is a liability. What do we do from the answers that we have? Michelle is saying C. Others, what are you saying? Precious is supporting Michelle. What about others? Coletta is saying C. So let's confirm. You're saying C is wrong. So Canon lawyer stated that there is a 20% chance of Canon will successfully defend the claim. So should provide I think from the possible answers there. So let's read the question, sorry, again. Prior to the financial year of Canon has received a claim of 100,000 from a supplier for providing poor quality goods which have damaged the supplier's plant and equipment. Canon lawyers stated that there is a 20% chance that this one is a tricky one. They've twisted the question. Can you read the question again? It's saying 20% that would defend, meaning that there is 80% chances that would lose. So it's not 20% chances that we would lose, but it's 80% chances because 20% is defending. So you are saying we should now go for D. Yes, so the correct answer there is D. So please take note of that. I think I also had overlooked that. It's 20% chances that we would defend. So it means it's 80% chances that we will lose. But the paper was fair. I don't know what happened. So it could be because of these issues. And all answers will be there. The one that you are thinking and the correct one. So let's do one more. How much should Gareth capitalize as non-current assets in relation to the purchase? Gareth, who is a registered sales tax, who is registered for sales tax, purchased a computer for use in his business. The invoice for the computer showed the following costs related to the purchase. So they purchased a computer, and those are the cost of the purchase. So the question then is, how much should we treat as the value of our non-current assets? Since we are a registered taxpayer, they don't suffer the sales tax because they are using okay. This one is for use in the business. Oh, it's a tricky one. It's again for use in the business. So they purchase this so that they can use it in the business. So if they are the ones using it in the business, what should be the proper treatment there? Let's read. So if they are the ones using it, the question is, how much should we capitalize as a non-current asset in relation to the purchase? A non-current asset we have for the non-current assets, we can consider the hardware. We can consider all the costs there. I think the 122. Then the maintenance is not supposed to be there. Maintenance cost is not part of the cost. So the 25, we're supposed to exclude it. The 25, we're supposed to exclude it. Then also, there is a registered sales tax, registered a computer for use. The invoice for the computer should, how should this be capitalized in the books? So if they are a registered taxpayer, they can recover the input tax. So yes, sales tax, that sales tax, generally sales tax, you're not supposed to be accounting for it. If you're a registered taxpayer, you recover the sales, the input tax. So you're not going to suffer the tax. You recover the input tax. So it means you are going to record 1040 less 25. 1040 less 25. How much is that? Because if they're a registered taxpayer, they are going to recover the tax, so they are not going to record that. So 1040 less the 25, that should be 1050. Yes. So just take note, if they were not registered, they would include the 182. Then maintenance is not for, the maintenance is not part of the cost. Unless maybe if it was once off, but this is being done over a period. So if the machine needed maintenance before it can be used, then we could consider putting it as part of cost. But if it is to be provided over a long period, then it ceases to become part of the cost. Okay, now I'm getting into another lesson. So we'll resume tomorrow. We have our next session tomorrow. Then the final session, we have it on Wednesday. So thank you so much for your time. For now, we are going to end here.